Filing personal taxes can be a daunting task, and even small mistakes can lead to delays or costly penalties. According to the IRS, common errors are made every year by taxpayers, leading to confusion or issues during the filing process. Understanding these common mistakes and learning how to avoid them can help ensure that your tax filing goes smoothly. This article will explore the top 10 most common errors in personal tax filing based on IRS data and provide helpful tips for avoiding them. 1. Incorrect or missing Social Security numbers. One of the most common errors when filing taxes is the incorrect entry or omission of Social Security numbers, SSNs, for taxpayers or dependents. The IRS uses SSNs to identify individuals, and mistakes can result in delays or rejections of your return. Ensure that all SSNs are accurate and match the ones on the Social Security cards or other official documents. Double-check this information before submitting your return to avoid unnecessary issues. 2. Math errors. Despite the convenience of tax software, math errors remain a frequent problem. Miscalculating deductions, credits, or income can lead to significant discrepancies in your tax return. The IRS advises taxpayers to double-check their calculations or use tax software that automatically computes numbers. If you're doing it manually, using a calculator and reviewing your math can help reduce these errors. 3. Failure to report all income. It's important to report all sources of income, including wages, freelance work, investments, and even side jobs. The IRS receives copies of all W-2s, 1099s, and other income statements, so failing to report income could trigger an audit. Be thorough and review all financial documents to ensure you report every dollar earned. If you're unsure whether something needs to be reported, it's better to include it rather than risk an underreporting penalty. 4. Wrong filing status. Your filing status plays a crucial role in determining your tax rate, deductions, and eligibility for various credits. One common error is selecting the wrong filing status. Whether you're single, married, head of household, or qualifying widow, choosing the correct status is essential. If you are unsure about your filing status, refer to IRS guidelines or consult a tax professional to avoid costly mistakes. 5. Incorrect bank account information. For those opting for direct deposit of refunds, errors in bank account details, such as the wrong account number or routing number, can delay the process or lead to funds being deposited into the wrong account. Always double-check your account and routing numbers before submitting your return. If you're unsure, consult your bank to verify the information. 6. Missing signatures. A common yet easily avoidable error is failing to sign and date your tax return. Both the taxpayer and the spouse, if applicable, need to sign the return. If filing electronically, ensure that your electronic signature is properly included. Missing signatures can delay your return and, in some cases, make it invalid. 7. Incorrect deductions and credits. Taxpayers often mistakenly claim deductions or credits they are not eligible for or fail to claim ones they are entitled to. Common examples include incorrect deductions for dependents, charitable contributions, or mortgage interest. Always review the requirements for each credit or deduction and ensure that you have the proper documentation to support your claims. Using reliable tax software or consulting a tax professional can help reduce errors in this area. 8. Failing to file or pay on time. Missing the tax filing deadline or failing to pay taxes owed can result in penalties and interest charges. The IRS is strict about deadlines, and procrastination can lead to unnecessary financial strain. Be aware of the filing deadline each year, usually April 15th, and consider filing for an extension if you need more time. However, remember that an extension to file is not an extension to pay. Pay any taxes owed by the deadline to avoid late fees. 9. Not keeping proper documentation. One of the most important aspects of tax filing is having accurate records. Failing to keep receipts, invoices, or proof of income and expenses can lead to errors when filing. The IRS recommends retaining tax records for at least 3 years in case you are audited. Keeping organized and up-to-date records can help prevent mistakes when it's time to file and make it easier to substantiate your claims if needed. 10. Not double-checking information from pre-filled forms. If you receive pre-filled forms such as W-2s, 1099s, or other income reports from your employer or other institutions, it's still important to verify that the information is accurate. The IRS receives a copy of these forms as well, and discrepancies can trigger issues. Be sure to check for any mistakes or discrepancies in the amounts reported on the forms and compare them to your records before filing your return. Filing taxes is a complex process, and even small mistakes can lead to delays, penalties, or other complications. By understanding the common errors that occur during personal tax filing and taking proactive steps to avoid them, you can make the process smoother and ensure compliance with the IRS. Always double-check your information, stay organized, and don't hesitate to seek professional help if needed. Taking the time to properly file your taxes not only helps you avoid unnecessary issues but also ensures that you are maximizing your refunds or minimizing the taxes owed.